So hello and welcome everyone to the launch event for the IEA World Energy Investment 2021 report. My name is Bella Tonkanogi and I'm Associate Director for Climate Finance at Climate Policy Initiative and delighted to be moderating this event. The event today will last an hour. We will have opening remarks from the IEA followed by a presentation of the main findings from the report, and then we'll hear reactions from two lead countries of the Clean Energy Ministerial Investment and Finance Initiative. And finally, we'll welcome a panel of investors to offer their perspectives. So without further ado, let me introduce you to Ms. Mathilde Worsdorfer, Director of Sustainability, Technology, and Outlooks at the IEA, to provide those opening remarks. She plans and coordinates the IEA's work on energy sustainability, encompassing energy technology policy and energy-related climate change policy. She oversees several major analytical reports, including long-term scenarios and technology roadmaps. The floor is yours, Mathilde.
Thank you very much, Bella, and hello and welcome to the SEM Finance and Investment webinar today. And we launch also the World Energy Investment Report 2021 from the IEA, and you will hear a little later from my colleague. I would like to focus my remarks on the issue of clean energy investments to meet the climate targets. We have seen in 2020 a proliferation of net zero pledges from governments, companies, and financial institutions. The financial community has also installed funds and initiative to channel a growing appetite on clean energy investment from capital markets and to comply with new disclosure rules. However, we can also see that the momentum from this climate pledges and also sustainable finance is not yet translating into large increase in actual spending to meet the climate goals. The IEA has recently launched the net zero roadmap by 2050, and this demonstrates how the world needs an immediate and massive deployment of clean energy in the decade ahead. The investment in a range of technologies, renewables, electric vehicles, energy efficiency, and other low carbon technologies would need to more than triple over this decade in order to keep the door open to net zero by 2050. This requires a broad range of governments, and we have here, I'm delighted, Denmark and Germany, to enable the financial system measures to attract increased capital from bank and institutions, as well as innovation in early stage clean energy technologies to prepare for the next stage of the transition. But there is an investment gap which looms even larger for many developing economies, where the pandemic and its effect have often been deeper and longer lasting, and funds to support a sustainable recovery are much less readily available. Just to give you one example from our new analysis, the emerging markets and developing countries without China represent nearly 2/3 of the global population, but they only get 1/3 of global energy investments and even less 20% of clean energy investment. And we also find out that in the report, in contrast to advanced economies and China, these countries in 2021 are set to remain below pre-crisis levels. So we need to focus on bridging this gap and find ways to connect the available capital seeking clean energy projects, including the growing wave of sustainable finance in North America and Europe, and also to translate it in opportunities in developing countries in Asia, Latin America, and Africa. While today's discussion will focus on the global picture and ways to build momentum, we are keen also to hear your perspectives on addressing these issues in the developing world. The IEA will come out with a special report on financing clean energy transition in developing markets on the 9th of June. Thank you very much for your attention and looking forward.
Thank you so much, Matilda, for those opening remarks, and really looking forward to that report on June 9th as well. So let me now turn over to Mr. Michael Waldron, Head of Investment Team at IEA, to present the main findings of the World Energy Investment 2021 report. At IEA, Michael's work focuses on assessing the implications of investment and financing trends for meeting energy security and sustainability goals. So over to you, Michael.
Thank you very much, and hello, everybody. As the presentation gets pulled up, just a bit of background information. This is the 6th edition of the World Energy Investment. This report is the IEA's annual benchmark in terms of tracking the capital expenditures across all the different energy sectors. So to really try to understand how all the different pledges and ambitions are actually translating into spending on the ground in real energy projects. We also look at the role of different sources of finance, financial flows, and also investments in future technologies through R&D, for example. But the focus is very much on trying to understand whether the world is investing in the technologies that we see as being needed under the IEA scenarios. With thanks to the investment team and a lot of other colleagues at the IEA who contribute this work, also thanks to the Clean Energy Ministerial for giving us the opportunity to launch this presentation during the CEM 12 and the support of the CEM Investment and Finance Initiative. Now, when we're looking at global energy investment in 2021, and also as a sort of background, a lot of the discussion here, we're going to focus on what do we see now in terms of the trends. So looking at what actually happened in 2020, but trying to understand where investment dollars are already going in 2021 based on the indicators and the data we're looking at through the end of May. In our previous World Energy Investment, we described how the COVID-19 pandemic delivered a shock to the energy system. This shock included a dramatic reduction in energy investment. And in 2021, what we're starting to see is that energy investment is set to rebound. It's set to rebound by around 10%. It's set to climb back almost to pre-crisis levels. And we are seeing a mix of a cyclical response in this increase in energy investment. So energy investment is responding to the resurgence in economic growth. It's responding to energy demand growth, which the IEA has posited at around 4.6% in 2021. But it's also responding to longer term structural factors, notably shifts towards investment in clean energy, which we'll get to in a few slides. It's worth keeping in mind that the country by country picture varies quite starkly. And a lot of this rebound that we're seeing is more in the advanced economies in China than in other emerging market and developing economies, as Matilda has already pointed out in her opening remarks. And that this increase in investment is also being coupled with a year-on-year increase of CO2 emissions, which, although they declined quite precipitously in 2020, CO2 emissions are back on the rise. We find that the companies and the developers continue to be in a fragile state across the energy sector. Developers are adapting to the new environment. They're using the window provided by more accommodative monetary policy and also government backing through stimulus plans to start to push infrastructure development plans and investment decisions for new projects. But the composition of these projects and investments has shifted quite dramatically since the pandemic began. And we're seeing a lot more of the investment coming in the sectors of power and the end use sectors and relatively less in fuel supply. And these are issues we'll continue to explore in the next few slides. Now, looking at the energy supply investment picture, and this gives you a very good contrast of the situation in the different parts of fuel supply versus power. The main message that we see in this slide, and it's also a main message that we've said now for several years now, is that the power sector led by renewable power continues to be the largest part of energy supply spending. We see power sector investment increasing by around 5% in 2021 to reach over 820 billion after the pandemic had flattened the spending profile in 2020. Renewables are dominating investment in new power generation, and as you can see from the graph, they're the ones that are upholding this lifting of power spending in 2021, accounting for around 70% of power generation spending and a total of about $370 billion of investment. It's worth noting that this increased investment it comes as costs for renewables, for solar PV, for on and offshore wind continue to decline. And we have an analysis in the report showing that $1 spent on wind and solar PV deployment today is associated with about 4 times more electricity output than $1 spent on the same technologies 10 years ago, because of these rapid cost declines, technology improvements that we're seeing in these technologies. But I would say this development or this deployment is still rather concentrated. So we've seen a lot of the boost in renewable power investment comes from a very strong year in China, very strong deployment in the United States and Europe, and relatively weaker performance coming in the rest of the world, which speaks to this notion that the rebound investment is not necessarily broad-based. I would also point out the strength that we've seen recently and expect in 2021 for investment in electricity grids and battery storage. These are key enabling technologies, as our recent net zero emissions report highlighted. Investment in this enabling infrastructure needs to accelerate in the years ahead. And there we're seeing strong planning and strong increases, again, in places like China and the United States, but also some increases in places where electricity grids need to keep expanding to meeting new demand. With an emerging pipeline of new projects also coming in battery storage, which has accelerated in spending from a low base in recent years. Now, looking at the fuel supply sector, one of the increases or one of the interesting trends we're seeing also relates to a degree of concentration in terms of the markets and the companies that are doing investing. This shows you the picture for upstream oil and gas investment by selected company type. We see upstream investment increasing by only around 10% in 2021, so it doesn't rise to the level where it was before the pandemic. This increase is coming on the back of a firmer demand picture, a higher oil price picture, but we're also seeing divergence in terms of the different company strategies. Across all the oil companies, we're seeing cost control as being a common theme, but across national oil companies in particular, we see evidence of some of them looking to invest countercyclically, seeking to gain market share. And a good example of this is a recent decision by Qatar to move ahead with one of the world's largest liquefied natural gas expansion plans, also including carbon capture in this investment plan as well. Meanwhile, we're seeing strong pressure on the majors and on the independents to keep their spending levels in check. We're seeing in other parts of fuel supply also a resurgence in the role of the state, most notably in coal supply, where investment is dominated by state players in China and India. Amid all this, we're still seeing the vast majority, 99% of fuel supply investment being devoted by fossil fuels, and only 1% of fuel supply investment being devoted to low carbon fuels like hydrogen, biofuels, and biogases. We'll talk about these in a bit more when we talk about clean energy, but by and large, the focus remains still on fossil fuels within the fuel sector. Now, when we're looking at the power sector and also picking up on this notion of the role of fossil fuels and also the dominance of state-owned enterprises in some sectors, this is also true when we're looking at final investment decisions for coal-fired power plants. So over the past 5 years, we've seen FIDs for coal-fired power plants down some 80% from 2015. So really, compared to where it was at the beginning of the last decade, there's not much new coal-fired power being built at all. And when we're looking at our long-term scenarios to meet long-term climate goals, this number needs to go down quickly, close to zero, in terms of building unabated new coal power. But yet in 2020, we saw a bit of an uptick in final investment decisions for new coal power plants. This was largely due to China, where authorities relaxed restrictions in different provinces for building plants. It was also due to the financial close that was achieved in several new projects elsewhere in Asia, particularly in Southeast Asia, but also South Asia. And as a result, this longer term trend of coal power declines, coal power FID declines, was something we didn't see in 2020. They still remain very low relative to historical levels, but it also raises a bit of a warning sign for eventually phasing out coal out of the energy system in order to meet longer term climate goals. Now, turning to the prospects for clean energy investment and kind of putting everything together, a major question is the world on track to generate the amount of clean energy investments that are needed to meet ambitious climate goals in the decades ahead. And when we're looking at the prospects for clean energy investment, we see room for a bit more optimism than we've had in the past. So in 2020, we saw a certain degree of resilience in clean energy investments. This was particularly true in renewable power, where investments actually increased. This was also true in things like electric vehicles and electrification, which grew strongly in 2020 and also set to grow in 2021. And again, in 2021, we're starting to see some of the early effects of stimulus spending and choices by governments to help different sectors recover from the pandemic. So efforts in Europe, for example, to direct money towards buildings efficiency and the retrofits of the building stock are starting to translate into increased spending in the building sector. We're seeing a large pipeline emerge of low carbon hydrogen projects, and we're also seeing a lot more activity in terms of contracting and project development for carbon capture, utilization, and storage, particularly when we're looking at its role in helping to decarbonize industries. Again, a lot of this is occurring in Europe and in advanced economies, and we're seeing less evidence of this in emerging market and developing economies. All of this means that clean energy investment is on a moderate upswing, but when you look at the share of clean energy investment in total investment, although that is also going up, the increase in that share over the past 2 years is as much due to the weakness in fossil fuels as it is to the increase in clean energy itself. When we're looking at the amount of clean energy investment which is needed in order to be consistent with a well below 2 degrees scenario, clean energy investment would need to double over the next decade, so during the 2020s, and clean energy investment would need to more than triple in order to keep the door open for a 1.5 degrees Celsius stabilization of the climate. So these numbers alone speak to the tremendous amount of acceleration which is needed in clean energy investment just to bring them in line with climate ambitions. So there's still a lot more work to be done. Now, an interesting trend that we notice is that the financial markets have responded quite positively in terms of their evaluation of different clean energy companies. When we're looking at some of the drivers of clean energy investments in the years ahead, this will hinge upon a broad range of government actions, including attention to the financial architecture that can help to accelerate these investments. And what we're seeing is strong momentum in the financial markets. First, in terms of the returns. So this picture right here shows you an update of the analysis that we did with Imperial College Business School several months ago, where we looked at portfolios of listed companies across the renewable power space, across fossil fuel space, and comparing this to the performance, the returns of the wider equity markets. And as you can see, over the past decade, particularly in the period from 2015 to 2020, renewable power actually experienced an outperformance with higher returns and also lower volatility than the fossil fuel portfolio, but also the market portfolio as well, suggesting that these technologies, these companies are ways for investors to diversify their portfolios and deliver better risk-adjusted returns. What we have seen, updating this analysis just for the first 4 or 5 months of the year, is that some of this has come down. So some of the increase in the renewables, the dramatic increase we've seen in 2020 has come off, and some of the performance of the fossil fuel companies has rebound, which narrows the gap a bit. Nevertheless, the valuations and the expectations from financial markets for clean energy investments remain relatively high. On the debt market side, we've also seen an influx, and of course, this is a very sort of common observation among market analysts, the dramatic growth in sustainable debt markets. So the issuance of green bonds, sustainability-linked bonds, et cetera, which has accelerated in recent years. Putting all these things together on the financial side, it still appears that things are changing much more quickly than in the real spending side. So we're seeing this acceleration of financial flows into clean energy projects and companies in particular, but we're not seeing the commensurate or corresponding growth in the actual increase in capital spending, although capital spending has been coming up a bit more in recent years. So it's that divergence which is interesting in the role of the financial markets in helping to drive real spending on the ground. Now, one area where we do see companies starting to make different strategic and investment choices is looking at the oil and gas companies. The oil and gas companies are under particular pressure from financial markets and also from societies at large, to reevaluate business models, and also to reevaluate the situation with changing market expectations for demand in oil and gas, and how to make that balance between meeting near-term needs for demand, but also positioning themselves to invest in the future and diversify their businesses. Now, this can encompass different aspects from the oil and gas company perspective. It can mean reducing emissions associated with the supply of oil and gas. It can mean reducing the volumes of oil and gas, or it could mean diversifying their investments into new areas. And our tracking of the different projects that oil and gas companies are investing in, and this picture here shows you capital expenditures. It doesn't show you some of the broader investments being made through mergers and acquisitions, for example. This shows some interesting momentum over the past year, and in particular of the first quarter of this year. So the projects that we're tracking and the commitments being made primarily by European oil companies seem to suggest a very strong uptick in the amount of spending which is going to be carried out on clean energy investments in 2021. If you were to carry through this momentum that we've seen in the first part of the year, this would put the spending on clean energy by oil and gas companies at something like around 4% of their total capital expenditures for the year, which would be a big increase from what we've seen in the previous years. With a lot of this, of course, underpinned by new projects in solar PV and wind, and in places where, but also more increasingly in places where oil and gas companies find synergies with clean energy projects. And as you can see, the largest increment here is in offshore wind, where oil and gas companies who are developing offshore projects already have certain advantages in terms of participating in this sector. So the last substantive slide I'll show in terms of the different graphs is talking a bit more about the longer term picture. So in our recent net zero energy report, or net zero emissions by 2050 report, one of the messages was that a lot of the technologies needed for the dramatic emissions reductions that are needed by 2030 are already market ready, but we also need to continue to focus on innovation and the spending in new technologies and their development that will enable us to meet longer term ambitions by 2050. And this has to do with technologies which are oftentimes at the prototype or the demonstration stage, and the ability to continue channeling research and development dollars into these technologies is really crucial for their development. Now, the preliminary indication that we have for global R&D spending in 2020, and here we're just going to focus on the prior year. We don't yet have an estimate for 2021. Is that global energy R&D spending by governments rose by around 1%. So this gives you some evidence that some of those previously committed public budgets remained resilient during the crisis. But this 1% stands in stark contrast to some of the larger growth rates that we saw in previous years. So R&D spending was growing on the order of 7 to 10% in 2017 and 2018, as you can see from the charts there. We've also seen a shift in spending over time. So increasingly R&D spending is going towards low carbon technologies, and over 80% of the spending was in low carbon in 2020. At the same time, the share of fossil fuel investment in the fossil fuel energy research has declined in many advanced economies, and now China has come to represent more than half of the global total for fossil fuel energy public R&D. That's just the public side. Of course, it's very important to stimulate investments and spending in private R&D. Looking at the corporate R&D sector, we find that the spending was less resilient compared to the public side. So we see a slight decline in 2020, which is notable given some of the increases that we've seen in the prior years as the pandemic started to weigh on corporate budgets and led to also some underspending in projects. So pulling everything together, and I'll just go quickly through the conclusions so we can get to the discussion. As I said before, we see global energy investment rebounding by around 10% in 2021, and this is reversing most of the shock of the pandemic, but the composition of that spending has shifted quite a bit since 2019. As we see spending in upstream oil and gas shift more towards state-owned oil companies, this also raises the prospect of greater market influence by these companies, or potentially raising risks around assets and energy security in the future. But this depends a lot on the speed of transition that we see in the global energy system. Clean energy investment, by and large, has been more resilient during the crisis. It's set for a moderate upswing in 2021, as we're seeing the initial impacts of those recovery plans being more visible in some markets and sectors, particularly on the demand side. But despite some of this strong momentum, despite the roles of climate pledges and sustainable finance, we're not seeing that acceleration of clean energy capital spending yet at the very large scale, which is needed to meet climate goals. Meeting these goals will depend a lot on the evolution of corporate strategies, including in traditional businesses such as oil and gas, with support for innovation a key pillar of net zero plans, and also putting a bit of a reference to our forthcoming report on finance and clean energy transitions in emerging market developing economies, which will come out on the 9th of June. The gap between these investment trends and the sustainable pathway is largest in this part of the world. So solutions on the policy side, on the financing side, to unlock investment in clean energy for these countries remains crucial for meeting clean energy transitions, but also supporting sustainable development more broadly. With that, I'll thank you, conclude the presentation, and turn it back to Bella.
Great, thank you so much, Michael, for the presentation, and really especially for the work to develop this comprehensive report with really clear takeaways across the energy system. And this kind of work really takes on even more importance in times such as the one that we're in now, in times of such change. So I'm very much looking forward to hearing reactions on the findings of the report from two lead countries of the Clean Energy Ministerial Investment and Finance Initiative, Denmark and Germany. So first, let's hear from Dr. Anders Hoffman, who is Deputy Permanent Secretary at the Danish Ministry of Climate, Energy and Utilities, where he oversees the areas of national energy efficiency, energy taxes, climate and energy behavior, research, data, digitalization, and telecommunications, as well as government-to-government cooperation. So I'm sure he has many thoughts to share about the findings of this report. So over to you, Dr. Hoffman.
Well, thank you very much, and thank you for getting the chance to comment on this important report. I mean, every time you open a sort of a newspaper or read the news, I mean, you see all these capital firms sort of having pledges that now everything is green and they will be carbon-free in 2050. And I think in that perspective, it's really nice that you have somebody who actually goes in and measure what is happening right now. Because I mean, we all agree it would be nice that we were all carbon neutral in 2050. But I think the main message coming out of this report and all the other work we're seeing is that we actually need the investment now. So just sort of a big thank you from Denmark of actually highlighting the need for doing something right now and not just wait 10 years or something like that before we actually start acting. So let me just sort of a few highlights seen from my perspective in the report. I think if we start with the good news, as was mentioned, I mean, at least you have that renewable energy investment are sort of the dominant part in power generation. I think that is definitely a good news. And as we saw on the graph just now, this has been a big shift over the last even 5 years. So I think that it's extremely sort of encouraging that you actually see that investment are going in the right direction. So I think that was important. Of course, as I mentioned, I mean, you also see the enormous gap between what is actually needed and what is happening. I think the number, depending on whether you're still believing in 1.5 degrees, which we are very much aiming at and hoping for in Denmark, I mean, you need a triple of the investment. I think that was the number that was mentioned. I think that's an important number to have, that when you're working and when we're talking with the financial market, it's a tripling of the investment. Of course, we as government has a lot to do with that, but it's also very important that we get the private sector involved. So a lot of more action is needed. I think just to sort of highlight of where we are in Denmark on this investing in clean energy, I think I will mention one policy example. We're quite keen on our energy islands. I mean, if you hear my minister, he will mention them all the time. And there's several reasons for them. Of course, we believe that this is a new phase in offshore wind, but it's also sort of an enormous investment, which we will do together with the private sector. So it's a public-private partnership in order to create this new type of offshore wind. I think the number is 30 billion euros we will invest in these of these islands over the next 10 years. So it's an enormous investment, just a way to show that this can actually be done and create a lot of impact. And of course, we can't do that without the private investors. I mean, a lot can be done. We can sort of de-risk, and I think this is one of the key also conclusion and message coming out of the report, that you need as government to de-risk and really try to see what kind of policy can you put in place in order to do that. And I think the work of what is actually needed is extremely important, because sometimes I feel the debate becomes too complicated, that as a country you need to completely change your financial system. And I think the message is actually, it could be much more simpler. I mean, of course you need to change something, but things you need to change in order to, for instance, have offshore wind or solar are not that big. I mean, countries can actually do it and start having private investment flowing in. So I think that's also a very important message coming out. We are working on something called the Climate Investment Coalition that is really aiming at that, sort of getting investments now and trying to tell countries the few things they can do in order to do that. I think actually a third important message coming out is the emerging market, which was also mentioned, and there's another report coming up on that. I'm looking very much forward to do that, because that's clearly where we need most action in the future. And you don't need to completely change them. It's a few things you need to do, and you will see, I'm pretty sure, great takeoff also from the private sector. I think my two more points actually. I think you also see the sort of the bad side of the report is that you still see sort of investment in coal-fired power plants in 2020. I was a bit surprised that I mean, I know the numbers have been going down, but it was still sort of a substantial amount of investment coming down. I think you saw some sort of encouraging news from last week with the G7 meeting, and also I think the IEA new zero scenarios, zero scenarios have really shown the way to do that. But of course, we need to phase out those type of investment. I think my final point would be that I was very pleased to see the last slide, where you actually, the work that you've been doing together with the Imperial College, we've been sort of following that for some time. And it's nice to see that you can actually make money on doing good. So there's a few things you need to do as a country in order to get the private investment, and as a private investor, you can actually make money doing good. I think that's a very strong, important signal. Of course, you also have, I think it was a very great number, that it was 1 to 4 the amount of electricity that has increased you get per dollar investment. I think that's also a very good number to mention. So I think those were my sort of, when I was both listening to the presentation and scanning and report, the most important things. So looking forward to a good discussion, and thank you for getting the chance to comment on this. Thank you.
Thank you so much, Dr. Hoffman. It's really important to hear how policymakers and government officials, sort of what is most salient for you and what is most interesting to you. So thank you for those remarks. So let me now turn to Mr. Thorsten Herdin, who has been the Director General for Energy Policy in the Federal Ministry for Economic Affairs and Energy of Germany since 2014. Prior to that, he held the positions of Managing Director of several professional associations for producers of power systems as well as engines and systems, and was the Managing Director of the Research Association for Combustion Engines, and finally, Managing Director of the German Engineering Federation's Energy Forum. So very interested to hear what your thoughts were on this report, Mr. Herdin. So over to you.
Yeah, thank you very much. And you may have seen an empty space all the time, but that was due to the fact that I was at another screen anyhow. First of all, thanks a lot for the IEA for that report. And as Anders was saying, and it was shown in the report quite clear, that there is still not enough investment in order to reach, I would say, Anders, 2 degrees, and specifically not to reach 1.5 degrees. But I think the report also showed that it's not a question that there is a lack of money in the market, but I think the experts will go into these details later on. It is some sort of a question of political framework together with, let me call it, a even more clear signal what we have sent today, because we've seen also in the renewable investment, a high ramp up, as it was shown in the report, but it is not as many of us would have thought continuing in the future. And why is this? We have recently in Germany a heavy debate on why the renewable assets are getting a little bit more risky. And I'm saying that because I have some sort of a side job, which is the chairman of the supervisory board of our state-owned fund, the CANFO, where our task is to simply invest 24 billion euro, which was given to us by the utilities for the intermediate and final disposal of the nuclear waste. And out of that money, we have to make 170 billion by the year 2100. So we are, I would say, a very unusual investor because we have an extreme long time investment horizon, which is of course excellent. So we can go in illiquid assets in a very, very large quantity. We see with our money, and we got 24 billion in cash some 3 years ago. That was also something which is quite unusual. So we got that in cash and had to build up this call it. And we've now invested roughly 20 billion. 20 billion we have invested to nearly 100 in illiquid assets. Why? Because it's extremely different assets. That is something perhaps where we as governments all around the world have to work on. If we are looking, and that is what the IEA report is saying, in a political and financial environment, it is quite clear that the financial sector is looking to ESG criteria heavily, but we still have not the standards available, which we need to have in order for the fund managers to really make it clear what are the criteria. So we need to work in much more detail on those criteria. We are talking about taxonomy in Europe, which helps on the one hand side. On the other hand side, it is very often the case that, for instance, if you look to gas, we are not talking about transition periods. We are talking on the end point of the phase. So what should the investor do? Should I invest in, let's say, a new oven in the steel industry, which will need at the end renewable hydrogen? But at the very beginning, it has to have gas, otherwise it doesn't work when gas is discussed as being the fuel which has to be taken out of the market immediately. A point to Mechthild Wörsdorfer, when I saw the last IEA report on the world's energy outlook, was first of all extremely thankful that the IEA is now going that clear route towards climate neutrality. But on the other hand, it gives the signal to the investors, skip away from gas. So how does that help in order to bring a transition period in place? Another point as an example, we have heavily discussed in our fund whether or not to invest in Ørsted. I think everybody knows Ørsted, one of the most leading towards renewable energy going companies. But at that point of time, they still had a little bit of coal in their portfolio, as they have right now. So there were ESG criteria which forbid us to invest in companies which do have coal in their portfolio. I can just tell you what a nonsense. So I could convince my people that we invest in Ørsted, and so we did. So what I'm saying is what we need, and I think therefore there also the IEA could help, is to set up criteria, to help to set up criteria not only in Europe, but all over the world. When I'm looking again into what is necessary, I would say we have a wonderful investment area if you just look into hydrogen, Anders was talking about offshore islands, and I'm now looking into hydrogen. We all understood that the world will consist of electrons as well as of molecules. And for hydrogen, we have the production of renewable energy, we have the conversion into hydrogen or derivative, we have the infrastructure, and we have the off-takers. All of that is not existing. All of that is not existing. So what a wonderful investment opportunity. But, and that is something where the governments worldwide, together with the help of IEA, but also IRENA, have to define criteria in order for the fund managers that they know where to go to. So that is something we should take up. So far from my side, thank you very much.
Great, thank you so much, Thorsten. That is certainly the first time that I've heard somebody say that they manage billions of euros as a side job. So thank you for the remarks, and it's a very good segue into our investor perspectives panel as well. So let's go ahead and move to that panel now. The panel is about new challenges and opportunities to mobilize capital at scale into clean energy transitions post-COVID-19. We have three esteemed investors with us today to provide us with their perspectives on how they view the market and what levers can be effective to accelerate the transition. And I'll first introduce all three of them, and then we'll go ahead and kick off the panel. So first we have with us Mr. Jan Johansson, who's the CEO of PKA, one of the largest occupational pension funds in Denmark. He has a Master of Science in Engineering and a graduate diploma in Business Administration. And before joining PKA in March 2020, Jan was Group Managing Director and COO of PFA, which is the Danish pension fund, for 10 years. So next we have Ms. Deidre Cooper, who is co-head of thematic equity within the multi-asset team at 91. Deidre is a leading voice in understanding and committing to sustainable investing, including engagement and integration of ESG into the investment process in order to address and combat climate change. So she co-manages 91's global environment strategy, which invests in companies enabling the transition to a low carbon economy. Finally, we have Ms. Maria Gillescu, who's the Chief Executive Officer and founder of Ardinal Investment Management, an investment firm focused on energy infrastructure that she started in 2017. And prior to Ardinal, she spent 15 years at Goldman Sachs, where she most recently served as a portfolio manager and managing director in the Goldman Sachs Investment Partners Group. She also currently serves as a director on the board of Macquarie Infrastructure Corporation, on the board of CDPQ, one of Canada's largest pension plans, and on the advisory board of AnyNext. So welcome to all three of you. Thank you so much for joining us today. So let me go ahead and kick off the panel discussion. So first, I just want to ask all of you, I think one of the points that came across in Michael's comments, as well as in Dr. Hoffman's reaction, was that there is this growing momentum around the world arising from all these different net zero pledges and sustainability pledges, but for the moment, it's not translating yet into large increases in actual spending on clean energy projects, and we're certainly not at that tripling of investment that the report has shown is necessary. So, as investors who are really working on this leading edge of clean energy investment, I'm really curious to understand how you see, or where you see, the investment opportunities ahead for you, both in terms of technology as well as geography, and what are your plans to turn this momentum into real increases in deployment on the ground? So let me ask each of you that in turn. Perhaps we can start with Jan first. So over to you, Jan.
Okay, first of all, thank you very much, Bella, and thank you for the International Energy Agency to put out this report. It's very important work, so thank you very much. First of all, also, I do agree that asset owners are ready to invest in sustainable finance, and also asset managers are picking up. Currently, we have already established a green portfolio of $5.5 billion in green investments. It's about 10% of our asset base. And we expect that to grow up to 8 billion by 2025. And by that, Anders, I can assure you we have lifted our fair share of the Danish pension funds pledge. So we feel very comfortable that the investments will grow even further than the original 50 billion. We do actually invest now, and we do see projects in the US, and we see some on its way in Asia. And just as an example, it's no more than a few months ago, we, in relationship to one of our solar plants in California, we invested in a very, very large battery storage. It's the same as 13,000 Tesla cars, so it's a fairly large battery storage. So we do see investments, but competition is picking up. There's a lot of money out there that want to be invested, and this is all back to a return risk relationship. And if returns are going down because competition is going up, we have a hard time. We have to make sure that our members, which are nurses, bioanalytics, physiotherapists, and so on, have a nice and good pension when they need it. So we have to make sure that return and risk are, in the right balance. So what we see now is, if we look a little bit ahead, is of course the Danish energy islands, which Anders also mentioned, with 4 gigawatt of wind power related to that. That's a huge project, and it's probably several projects, and we look very much forward to hopefully participate in that. Also, the work of organizations like the Climate Investment Coalition and the IIGCC is something we hope will develop not only green asset investments, but also help with the first steps of how to actually embrace power to X. This is very important. I think power to X is like the perfect technology. It will help us take out the surplus when we have surplus in our wind farms and solar plants, and convert it to transportable energy, which is fantastic, and we could be used in ships and so on with no huge costs. It's really something that we look into. So power to X is something that we are looking forward to invest in, and I know that the Danish government has actually put aside money, so we are ready to co-invest. Thank you.
Thank you so much, Jan. Let me turn now to Deirdre for your thoughts and reactions.
Thank you, and I'd like to echo Jan's comments on the quality and value of the report. I think from our perspective, Mathilde and Michael already addressed many of the key points that are important. The first being that there is a multi-trillion funding gap, and that we as asset owners and asset managers have a role to play in that. And I think crucially, the biggest funding gap by far, of course, is emerging markets ex-China. And this is something that we at 91 feel very acutely, because we're an asset manager that was born in an emerging market. We were born in South Africa, and a large part of our business is focused on investing in emerging markets, both equity and debt. I would also note that I think the Net Zero Alliance, both the asset owners and the asset managers, is absolutely key to unlocking this capital. I think this initiative has just been enormously successful in highlighting the climate issue and in mobilizing asset owners and asset managers to address it. But we think it's also really important to develop net zero targets that acknowledge the emerging market funding gap. And of course, more broadly, in terms of climate metrics, and to some extent, Thorsten touched on this, there's a lot of nuance in understanding the metrics. Thorsten talked about how difficult it was to invest in Ørsted, because Ørsted at some point was still transitioning from coal. These kind of issues are even more important as we, more broadly across the industry, start to set net zero targets. So for example, if you were to take a general global equities portfolio, if you were invested in the benchmark, in MSCI All Country World Index, and you doubled your weight in emerging markets, that would make your scope 1 and 2 emissions intensity, which is the target that people are setting, that would make it about 10% worse. If you were to double your weight in the biggest tech companies, you took the 3 biggest, that would make your scope 1 and 2 emissions intensity about 7% better. So when you're setting those targets, it's really important, I think, for people to report not just the target, but also the attribution in getting there. And we think it's particularly important that these targets don't end up with this unintended consequence of allocating more capital to large cap US tech, which is an area that is not short of capital, not one that is particularly driving decarbonization that's going to help us solve this multi-trillion-dollar funding gap, and pulling capital out of the emerging markets where it's most acutely needed. So we think it's really important that the attribution behind those targets is understood. Even more important when we understand that 90% of emissions growth is coming from emerging markets. So over time, as you allocate more capital to emerging markets, it's going to become harder and harder to meet your carbon targets. But that can be adjusted for, and we can report, those targets in a way that adjusts for country and sector biases. And we think that's really important. John alluded to the IIGCC framework. We think that's a really great framework because that looks at decarbonizing existing portfolios, but it also acknowledges the importance of investing in climate solutions. That's something that we feel very strongly about, and we think that investment in climate solutions should also have with it a particular focus on investing in climate solutions in those parts of the world that need it most. So we're in the process of signing up at 91, for example, to net zero asset managers, and we plan to set the targets in that way, which will make it much harder for us to meet our targets, because we're going to have to do it in a way that adjusts for sector biases, for regional biases, and then also have that positive investment in climate solutions. And maybe to finish, I'd love to echo Anders' comment, which is we really believe that these positive investments in climate solutions, this focus on decarbonizing portfolios in a way that not just decarbonizes the portfolios, but has an impact on real world emissions. And those are two different things. Low carbon portfolios and portfolios that drive a low carbon world are two different things. We think all of those can ultimately in the longer term be accretive to returns. So to the nurses and the biochemists, that Jon looks after, and to all of our pension holders and savers that we look after.
Great, thank you so much, Deirdre. That was really interesting. So I heard from Jon that there are some interesting dynamics in the renewable energy market, in particular competition actually potentially driving down returns, and some nice opportunities in offshore wind, which is also an opportunity, it sounds like from Mike's presentation and Anders, for oil companies to participate in. And then we heard from Deirdre actually this law of unintended consequences, that the targets and the metrics we use really must be focused on the real economy and having impact in the real economy rather than sort of a target for a target's sake. So very interested to hear your perspective now, Maria, on where this market is headed and your role in it. Thank you.
Yeah, thank you very much, Bella, and good day, everyone. It's been a fantastic discussion, and I very much enjoyed it. I'm going to try to put it all together from the two previous investors, because you picked two good examples of people really making a difference in the investment community. But when you take a step back, like you said, there's a lot of talk and very little action. And the question is, why is that? And from my perspective, I think that's because the signal that we've gotten from government so far, the signal hasn't been strong, and the firmness of the goal is not there. And it's helpful to see all of these ESG funds and net zero pledges. I think that they're a helpful start, but we really can't rely on those to accelerate the momentum in green spending, which is what this report is about. A lot of these ESG strategies, especially in the public markets, are secondary market transactions, right? You buy company A and you sell company B because company A is better from an ESG score standpoint than company B. So over time, you could argue that it creates a better cost of capital for company A versus B. But in the meantime, there's no new capital flowing. There's no primary capital flowing into either company. So it's a zero-sum game. So we need to focus really on new capital flowing. And we have seen large private investments into green projects, like you've seen from some of Michael's charts, but it's when the economics are compelling. It is still the case that you need the economics to really stand. So either the technology has matured and costs have come down and the projects stand on their own in terms of economics, or the technology is known, costs haven't come down, but the regulatory environment is stable, and you can see that to plug the wedge with tax credits or subsidies or in some other shape or form. So we've seen that in wind, we've seen that in solar, we're starting to see that in energy storage, which is encouraging. But outside of that, we haven't seen much momentum anywhere else. And there's a lot of promising technologies, but we're short in one of these aspects that I mentioned previously. You know, costs are not yet competitive. When you look at green hydrogen, the technology is not at scale. When you look at, let's say, renewable fuels, those will always have to be subsidized. Same thing with carbon capture. It's very promising, but the regulatory burden is significant, really significant. And that's why we're seeing a lot of talk and sadly, very little action. And I'll make one more quick comment about the different geographies' response to the pandemic. We've talked a lot about the emerging markets, so I'm not gonna speak about that, but I'll contrast Europe versus the US. After the pandemic, Europe took a holistic decision to focus on building its own green energy infrastructure, primarily with public money. And the decision was very top down. We're focusing on building out battery manufacturing capacity, EV charging infrastructure, green hydrogen. It's a decision that has been made, and you know, Europe's dedicated hundreds of billions of euros to it. The US has taken a different approach, and it's still relying to a great extent on private capital to build green infrastructure. But unfortunately, in the US, we don't have the right regulatory stability that sends private capital the signal to invest. And we've seen this, we've seen positive things happening in some select states like California, for example. They have favorable legislation, but it's a patchwork approach. And unfortunately, I don't see this mobilizing the kind of capital that we need to get to a 2-degree scenario, or even less so to a 1.5-degree scenario. So I'll just stop here, and we can continue the conversation in Q&A.
Thanks so much, Maria. I think that's just a really good segue into, you know, the second round of questions, where we really want to kind of explore a bit more what you're talking about with regulatory stability. What does that really look like? And in particular, you know, both in developed economies, which have been able to, in particular in Europe, really rely on and deploy stimulus spending in a way that has this emphasis on clean energy and sort of this future climate friendly and resilient economy, versus in particular developing economies where the pandemic is going to be longer and they have less fiscal space to extend that kind of stimulus. So, you know, what I really want to understand is, you know, from your perspectives, sort of what are those levers that are that can be most effective to driving us towards or accelerating this clean energy transition, and also to sort of leaving that fossil fuel intensive world behind. I think the report has a nice point where it says that we are caught between two worlds, and I'm just really curious, how do we complete that leap from one world to the next, and what would you recommend? So, and why don't we go in the same order, start with Jan and then go to Deirdre and Maria.
Okay, well, that's a very good question. And I think it's back to the same simple relationship between return and risk. If we look a little bit back, in Denmark and in many other countries, the government took out some of the risk of our investments by guaranteeing, you know, minimum prices and so on. And that gave us the ability to actually make the investments. And I think that's it's very easy to do. It's of course something that the government has to decide and think about whether they can do it. But by doing that, the return risk was actually attractive for us as an investor. And then hence we could guarantee that our members in the pension fund could actually get a pension when they went on pension. So I think that's sort of the simple work we have. You could also put up tax regimes and so on to penalize fossil fuels, but it's a lot more complicated. The other way around, it's a lot simpler, to my view. And if you look into the developing countries, I'm sure it's pretty much the same thing, but it's a lot more difficult because of the maybe social and political stability is not the same as we see in Europe and in the US. And it is something that we have to look upon. But what we could do is that we could have the same sort of guarantees, or at least taking out some of the risk by developed countries' governments, and then we will do the investments. And we have here in PK, we have already made an investment for a big wind farm in Africa, and it works actually quite well, and it's a very important part of the infrastructure in that part of Africa. So it is possible to do that type of investments, but I think the backing has to come from, you could say, the strong countries in Europe and in US.
Thanks, Jan. Let's turn right over to Deirdre.
I'd agree with all of that. I think maybe just as an overarching comment, I think we'd also agree that, you know, taxing or penalizing fossil is less important than incentivizing positive investment. And in that case, the key is visibility and consistency, because the big difference between, generally speaking, climate investments, whether it's renewable energy, whether it's efficiency investments, is that they require a lot of upfront capital, and the payback comes over time. So unless you have a really visible, consistent framework, then it's impossible to put money to work, because the payback is longer, and you end up taking the dirtier but shorter payback option. So I think that's really important. I think we touched on this earlier, but context is important. The pathway that works for one country with a certain renewable resource or a certain amount of access to electricity is not going to be the perfect pathway for others. And I think it's important to acknowledge that countries, you know, will work on different decarbonization arcs. The Paris Agreement acknowledges that. Investor frameworks don't always acknowledge that. Blended finance has an enormous role. I think there needs to be more cooperation, but between people like us and the development banks. We work with some of them. We manage a product at 91 called the Emerging Africa Infrastructure Fund, where we work closely with development banks in the UK and Switzerland in order to invest in infrastructure projects in Africa. And then finally, I think innovative financing mechanisms need to be used more. I think the growth in the green bond and sustainable bond market has been exceptional, but the issuance has typically been very focused on developed markets, you know, as I guess bond issuance is in general. But I think more of those instruments can be more widely used. And we're actually starting to see this year with a huge increase, for example, from our emerging market corporate debt team. They see an enormous increase in the number of their companies that are starting to issue green bonds. And I think that will really help.
That's great to hear. Thanks, Deirdre. Thanks for those concrete thoughts on what we can do better. Over to you, Maria.
Yeah, I think Deirdre's point was spot on. We need visibility. We need visibility around the end goal, and we need firmness around that. And for example, we don't have that here in the US because we simply just can't find a bipartisan way of agreeing on these set of common goals. You know, it'll be interesting to see what happens with the infrastructure package, but the lack of consistent visibility is a big problem. So, you know, what can you do in the meantime? You can only do things on the margin. You can see, you know, there's existing policies where you could incent investment within the existing legislation. And here in the US, there's things that you can do in terms of, you know, federal siting, building transmission infrastructure, debottlenecking some permitting processes. But again, this will be on the margin. Marginal options give you marginal outcomes. So we need to find a more comprehensive way to really rally everybody behind this common goal. In the developing countries, I'd add one more thought here really quickly, because I know we're running out of time. You know, they can really benefit from the cost downs that happened in wind, in solar. And when you look across emerging markets, a lot of geographies have access to 2-3 cent a kilowatt hour type of power prices through wind and solar. And you can roll out distributed power because you don't have this monster incumbent 100-year-old system that we have to worry about in the US and in Europe. So the same way that emerging markets bypassed landlines and went straight to cell phones, I can see this playing similarly, especially on the power side. And on the mobility side, I see a lot of encouraging trends happening in terms of cost downs in batteries. So you can make very affordable 2-wheelers, 3-wheelers, small passenger cars that compete really well from a total cost of ownership standpoint with ICE cars. The problem is the industry, the cement, steel, the heavy industry in developing markets. Those will be very, very difficult. And I don't think that, absent some carbon price or border adjustment tax, it's going to be hard to solve. But on the power side and on the mobility side, there's a lot of promise and there's a lot of things going in the good direction. So, let's not don't let perfect get in the way of good, and let's try to accelerate this momentum.
And thank you so much, Maria, and thank you to all three panelists. I think that was quite a hopeful note to end on, both in really kind of identifying some really concrete solutions. All three of you just did that. I heard in particular a few themes there between consistency of policy and stability of regulations and regulatory regimes. The context is incredibly important, and I think that's especially true in developing economies, but of course also in developed economies. And the last thing I heard was really simplify. So, that there are simple solutions that can work, and the simpler that we can make it, and the more that we can focus on the good rather than the perfect, the better, the more effective we can be in driving this transition. So with that, let me close the event. Thank you all again, all of the panelists, and particularly the IEA for the excellent work, and really the excellent work to drive this conversation. And thank you again, and have a wonderful rest of your day. Thank you.